In this video, we are going to show you how to pass prop firms fast using the revolving door approach. This method is so great because it works really well with expert advisors, but it's also fully within the prop firm's rules. So there's no HFT, no trade copying, no funny business, which will get you banned. This is a legitimate method, which is actually taking advantage of the prop firm environment, but at the same time being fully within their rules. So maybe for some context, one of the issues with trading in general, or prop firms specifically, is that there's hot streaks and there's cold streaks. So as much as we'd love every day to just be like a nice even sequence of wins, unfortunately there's certain times where whatever strategy you're using, there are going to be strings of losers. But fortunately, there's other times where there's the strings of winners. And we've noticed that this is particularly true when you're using very high win rate systems. So many scalping systems, they have lots and lots of wins and then larger losses, but the distribution of these losses and wins tends to be in streaks. And this is true with many other strategies as well. What the revolving door approach does is it uses the concepts of hot and cold streaks to be able to pass prop firm accounts faster. So maybe to break it down a little bit more with this PowerPoint, essentially what you're trying to do is you're trying to capture winning streaks to pass accounts faster. And how you do that is by, instead of buying, let's say, one $100,000 account, you would simply take that account and divide it by 5, in this case into $20,000 accounts, and then you would spread it across 5 different accounts. And instead of trading one account by itself with all of your size, you would trade 5 different accounts and actually 4 different accounts simultaneously. And how that works is you start the accounts up in a staggered approach. So to dive into this example specifically, you would start with account 1. This is one, let's say, $20,000 account. And you would trade it until you have X amount of trades. In this example, we will use 10 trades. After which, you would keep trading account 1, but once this 10 trade period has passed, you will also start trading account 2. And you will be copying and doing the exact same trades in both accounts. But the general premise here is, let's say you had 2 losers here in your 10 trades. That could set back your account passing quite significantly. But if this entire string were only winners because you're trading a high win rate system, account 2 will pass faster than account 1, despite the fact that you started account 1 earlier. So the general premise here is when you're initializing all of your 5 accounts, every 10 trades, you would start up a new account. This happens until you reach account 5. Once you start up account 5, the other aspect of this system comes into play, which is the account pausing. You want to always have a certain deviation between when your accounts are running. And obviously you don't have unlimited money to be buying infinite prop firm accounts. So what you would do is upon the start of account 5, account 1 would then be paused for a series of 10 trades. So this is the pause here. And then you would restart account 1 after that 10 trade embargo. So effectively how this works is you would run one account for 40 trades, pause for 10 trades, run for 40 trades. Or here, and you can replace 10 by X or 40 by 4 times X. So depends on your particular system. But in this example, I have found 10 to work quite well. And this approach effectively allows you to always have some accounts in the market, but not have all of your eggs in one basket. And you're essentially trying to not have all of your accounts take the brunt of a loser, and this should enable you to pass faster. It might be a bit confusing right now, but I will dive into some more concrete examples to show you a bit more in depth. Maybe just to go over the rules. So the rules of the simulation, or not even simulation, I did this live and I passed prop firm accounts with it, that I'm going to show you are as follows. So there's really two different aspects, the risk management and the rotating aspect. With the risk management, what I'm assuming here is you're running high win rate strategies. So these are strategies where you tend to win way more than you lose. And specifically, in the case of this example, I ran some of our expert advisors here at Prosperity Algo, specifically Missile and Striker, both of which have a 1 to 5, 1 to 4 risk reward. So you win over 80% of the time, but your losers are more significant than your winners. But that actually works perfectly with this type of revolving door approach, and you'll see how when I dive into the spreadsheet. So in terms of risk management, you want to only allow your system to risk 2% of the account balance per day. This enables you to A, stay well within the daily drawdown limits of the prop firm, but also you're never going to overextend your account if you follow this approach, or you might if you're not using a high enough win rate system. But let's say you're using a very high win rate system, a 1 to 5 or a 1 to 4 inverse risk reward, then risking 2% of your account balance per day should be appropriate. If you're using a 1 to 1 or somewhere where perhaps you even have a positive risk reward, don't risk 2%. So if you guys would like, please comment spreadsheet in the comments below, and I can send you a risk reward calculator spreadsheet to provide some more context. Moving on to the second rule, if you're going with this 2% of account balance per trade risked, you want to only allow 1 loss per day. Makes sense, right? If you were risking 2% times 5, you can rapidly blow your account. Going with these two previous points, you only want to allow 1 position open at a time and only 1 pending order open at a time. This is very important because let's say you have 1 position open and 2 pending orders open. You can trigger the pending orders before your position closes and then blow your account or hit your max daily limit. So it's very important to keep this in mind. All of our algos here at Prosperity Algo and our EAs specifically, they have a toggle to enable only 1 max loss per day. So you should be able to use our bots to enable 1 max loss per day. Some of our bots as well, they don't have a filter for pending orders. However, if you'd like, we can make an adaptation there, or you can simply shut the bot off as soon as the max daily loss is hit. Please let us know if you plan on implementing this approach, and we can advise on any modifications which might be required. Moving on to the rotating aspect. Here in this specific example, you want to essentially take whatever prop firm account size you can afford. Let's say you can afford a $100,000 account, or you can afford a $10,000 account. That is the account which you would normally buy, and you want to just divide it by 5. Like I'm not advocating for you to go out here and buy 5 times $100,000 accounts if you can only afford 1. That would be quite irresponsible. But essentially you want to take that big account and you want to spread it out. And the added benefit of that is you can even spread it out across prop firms. So as we've seen in the past few months, prop firms are not exactly the most solvent organizations in the world. Therefore, by spreading your risk out across organizations, you might actually further diversify your risk exposure, which is quite beneficial. As we saw in the previous slide, you should also only have 4 accounts open at a time, and every 40 trades, you should pause the account. So these are the rules which I was using, and I did pass prop firms with. But once again, keep in mind, this works well with high risk reward systems. Oh, sorry, not high win rate system, low risk reward systems. Apologies. So let me show how this actually would look. This is an example of live trades. So these were trades which I copy and pasted from our live account. And as you can see, we started off pretty small in May when we were starting to run these systems. And they got significantly larger as time went on because we became more confident in the system. But ultimately, the real size which we traded with live was less relevant for this example. So they were all adjusted here to be used to the size which we would be trading in the prop firm account. So perhaps to give some more context, all of these columns represent a pull from MetaTrader. So these were what was actually traded live by our systems. And we've continued to trade these systems live until today, and they've performed very, very well. And as you can see here, this is Missile and Striker combined, but with a risk management approach that only allows one loss per day and only allows one pending order open at a time. And we're seeing our win rate was roughly 90% or 89%, and our loss rate here was only 11% or 8 trades. And that speaks to the rules mentioned earlier. As you can see, the losses were fairly infrequent with these very, very long strings of winners. And I can even pull up Missile, which is running today. Give me 2 seconds here. Okay. The terminal took a few seconds to load, so I just rapidly cut the video. But this illustrates the same point live. You can see here in this terminal that this is just Missile running by itself, or good example of most high win rate systems. You have very, very long strings of winners and then loss. Very, very, very long strings of winners. We're currently on a hot streak, which is always nice. But up here you can see we had loss, loss, and then a very long streak of winners. But this type of system, going back to the spreadsheet, works perfectly with this approach because you're able to capitalize on these long strings of wins to essentially pass your prop firm challenges. So going through my spreadsheet here, you can see that we took whatever these live trades were and we normalized them based on the following parameters. Here I was assuming a $10,000 account. And if you essentially work back, you can see that that works to a trade size of around $85,000, assuming leverage, and seeing as our stop loss is 0.25%, our max risk, simple calculation here, is going to be 2% of the account risked per trade. And clearly you can see here, it's roughly that approach is being taken into account, right? Like when we are having winners, they're smaller. And when we have losers, they're roughly 2% of the account. And then what I did is I modeled the 5 rolling accounts here to show how this would look had these trades been taken on the prop firm challenge. And then you can see this would be an example of trading account 1 until we hit 40 trades and then entering the embargo. Then here, after 10 trades, we would have started account 2. Wait another 10 trades, start account 3. 10 trades, account 4, and so on and so forth. But as you can see, up here, it took us quite a while to actually pass account 1. It took 56 trades. This was simply because account 1 happened to be started when there were quite a few losers. So account 1 caught a losing streak and took a decent amount of time to pass. However, account 3 was far more fortunate and did catch some losers, but nothing nearly as significant, and it actually passed significantly faster. Here's an example of account 5. I think account 5 only caught, it caught 1 loser. So as you can see, it passed extremely quickly. In terms of trades, that's going to be 23 trades. So I hope this conceptualizes how this approach works. You're able to effectively always have some cash flow certainty because not all of your eggs are in one basket. And perhaps I can show another example here. This would be an example, same approach, Missile and Striker. This is coming from a back test actually, so these were live trades. This is the back test, but it just gives you a longer sample period. but effectively it shows how this would work in the context of payouts, because you're passing, but you're also assuming that every Friday you take a payout. And as you can see, this was a prop firm that allowed weekly payouts, by the way, just FYI. This would be a little bit different depending on the institution you're using. But essentially, as you can see, you're having continuous cash flow coming out using this approach. So let me just quickly go back to our PowerPoint here to reiterate on the rules. This works fantastically with a very high win rate system. So if you would like to see any high win rate systems, please feel free to check out our bots here at Prosperity Algo Solutions. They are all acceptable for this. And if you require any suggestions on how to tweak them to make them prop firm compatible, or any guidance, please feel free to drop us a note at info@prosperityalgosolutions.com. And yes, so I hope this video was helpful for you, and please stick around for the following short clip where we'll explain our time bomb system, which would be suitable for this approach. Thank you and take care. Before you click away, if you're looking to get a real expert advisor, here at Prosperity Algo Solutions, we're currently offering our golden time bomb system based on automating the London breakout and opening range breakout 100% for free. Watch the pinned video to find out more and to get access.